Welcome to TheoTRADE. This is Don Kaufman. It's January 5th, 2024. There's just minutes left inside of this first trading week of 2024. And wow, what a trading week it is. You know, it's a shortened kind of holiday week, only 4 days in trading this week. Obviously, January 1st fell on a Monday. So we're 4 days into this. And I got to tell you, 2024 starting off with a bit of volatility. All right, this weekend's update: when good market news goes bad. Obviously, a lot of people will know that there's tons of economic data that came out throughout the course of this week, including, of course, last but definitely not least, non-farm payrolls, right? That non-farm payrolls, it's decent. And that good market news initially caused, well, here, take a look. S&Ps, things got squirrely in a hurry. We got a bid back under us, but there's definitely some issues facing this marketplace right now. Look, let's get right down to it. Less of a recap over here. Like, everybody understands what happened throughout the course of this week. Look, there's some sell side activity transpiring in the marketplace. Newsflash, everybody's watching markets. There's some sell side activity, but there's not that big, punch, if you will, of volatility. And it's, again, disconcerting. You're probably going to hear the word disconcerting a number of times on this weekend's update because, well, there's a number of issues with this marketplace. So as I said, let's get right to work. One of the first things that's a big standout in the midst of some sell side activity, and look, it's only a 4-day trading week, as I was alluding to a moment ago. Let's take it over to the SPX, the mother of all products. And the reason I'm starting in the SPX is because the SPX, there was just shy of about a $52 move being implied this week. So you're supposed to move 52 bucks. Where are we right now? Outside the expected move. And we're going to close outside the expected move. How do I know that? Because there's only 40 seconds left. Anyway, we're going to be outside the expected move. So we start off the year with a little bit of bang in terms of implied volatility. But I gotta tell you, from my perspective, first of all, I've been pricing all kinds of trades today. I'm trying to get into Christmas tree spreads. If you don't know what that is, it's kind of like a funky ratio spread where I go out and bottom line is I sell a bunch of puts and have kind of an internal hedge on it. It's not pricing well. I literally backed away from the screen. I'm like, forget it, and walked away. I'm like, I'm not getting the price I want. Okay, I'm out of the contest. I have no reason to force a trade. There's the closing bell. But I have no reason to force a trade if the pricing's not going to be there, and I'm just not going to do it. It's still, even though we had some sell side activity this week, one of the things also that kind of stood out, the volume. It was there, but it's not exactly like rocking. It's the first time in a while we've seen any sell side activity, and the volume was a little bit lackluster, especially inside of the options market. On Thursday, which markets moved on Thursday, we only did like 39 million option contracts. For those of you that do not speak options geek, last year we averaged about 44 million. So, to do below average contract size and sell side activity, again, it leaves something to be desired, which brings me to the first bullet point. First bullet point is this. Look, we haven't seen any sell side activity in a long time. Let's cruise back over to the spiders. The spiders they'll do us some justice, right? And the reason I'm going into the spiders is just to allude the fact that, we've been basically straight up from 410 right up here to the 477. So we've dropped a little bit, but it's been so long since we've seen any sell side activity. It's my fear that there's a lot of what I term volatility starved animals out there. What that basically means is, it's been so long since we've seen any sell side activity that volatility, the second that volatility starts to emerge, premium sellers come out of the woodwork. And what actually intimidates me is a day exactly like this, where, today, there were periods of time today where it really looked like we were going to sell off, yet the VIX fell all day. Now, look, I'm not a big VIX kind of guy. Volatility futures, okay, diminished all throughout the course of the trading session. And if you look down at the screen like VVIX, that's the volatility of the volatility index, fell all throughout the course of the day. So, where's the volatility? Because when I say where's the volatility, this wasn't exactly, straight up on the day. It was straight up earlier, but in what was a precipitous move. I mean, we moved from like 47.60, pulled all the way back to basically 47.20. That's a 40 handle move back down. So you have this enormous 60 handle move. Okay. Then you actually retrace 40 handles back down. And what does volatility do? It goes, eh. Okay. And I'm going to tell you exactly why it did that, because people were coming in and they were actually selling puts. And it really diminished some of the implied volatility. So it is my estimation at this point in time, we have a lot of volatility starved animals. Be careful with that notion. What it basically means is it's been a while since we've seen volatility. The first sign of volatility, people come out of the woodwork and go out and sell some puts. Okay. You may be actually selling yourself into oblivion. Look, I don't, okay. I'm not going to sit here and, prognosticate we're going higher, we're going lower. I'll talk about that in a couple of moments. Okay. But I can tell you one thing. I don't like when there's sell side activity in a marketplace and the volatility isn't budging. Okay. Now, I don't care whether you think that's a bullish or bearish connotation. It's not meant to be a bullish or bearish connotation. I don't like it because I want to get paid for the risk that I'm taking. I want to see fear and loathing before I actually step in, or at least, okay, sell side activity that isn't met with what? Premiums being lower. And that's what it's one of the reasons, like I said a moment ago, I tried to fill a bunch of trades today. Pricing, I'm just going to throw it out there for you. It sucked. Pricing was just not good. Sorry to be so blatant about that, but it was absolutely terrible. Some of the pricing out there, which, the skew isn't half bad. Skew's up to like 136. Maybe that came off a little bit today. I don't know. We'll have to see skew after this close. But I can tell you, it just didn't feel good to try to sell any premium today. If you're a volatility starved animal, that is an individual just that cannot wait, okay, be constrained. If you have to, sit on your hands. And I'm serious about that. Sit on your hands. I don't care. It's been 4 or 5 days. Look, the S&P's finished a little bit higher today, but there's some issues. Next on the docket, okay? So first bullet, don't be a volatility starved animal, okay? We're all hungry for volatility, but you don't want to be the person that goes out there, unloads the bus, okay, before the bus really shows up. Look, number 2 over here, economic data challenges the rate cut logic. So that's really what the title is about, on this weekend's update. The title is basically about when good market news goes bad. That just does it for me. Let me tell you, when good news is no news with Gary News. I screwed that one up, but nevertheless, what I'm actually referencing in here, look, better data is coming out. We actually had a number of different economic drops throughout the course of the week. Okay, one of the ones that was actually a real kicker is today. Today is after the market was open. Let me cruise over to the S&P futures. But after the market was open, okay, right over here was good economic news. This is good economic news. The market dropped. Over here, it was kind of a mixed bag of goods, and the marketplace rallied. It was like some ISM, a little durable. Anyway, and then the market rallied because it was mixed data. The data wasn't as good, but we have a really interesting situation where good news is actually causing the marketplace to effectively sell off. And listen, a lot of people, they don't believe in the jobs number anymore. That's fine. I don't care. Okay. It doesn't make a difference. The jobs number came out and the jobs number was strong. The jobs number was basically 216,000. The estimate was 170,000. The jobs number beat. The marketplace had a precipitous sell-off and rallied back. But you know what? When it comes to economic data, okay, stop looking at the S&Ps. That's the big one. Stop looking at the S&P. Start looking at the bonds. The bonds, okay, they're fading. If I didn't know better, I would say that was trend worthy. The bonds are making a real move over here. So the S&P is a little sell side activity, but the bonds, it's a bit more. And I'm going to tell you right now, the volume in the bond market, that's a rockin'. Okay, so there's some sell side activity inside the bonds. The bonds basically had this move that ensued here from basically November into the end of the year. That was the single largest move ever up in the history of the bond market. Okay, but now they're starting to fade a little bit. That is critical. If the bonds continue to fade, so goes the marketplace. Keep that in mind in the very near future. But the point being of this, okay, is that entire notion that they're gonna cut rates, it's fading and fading fast. If you take a look, this is the Fed Watch tool provided to you by the Chicago Mercantile Exchange. Anyway, this is the January 31st Okay, they're basically saying nothing going to happen. In January, we're not going to cut rates. 93% chance they're going to hold rates 525, 550, 525, 550. If you go out to March, okay, and again, I was very, very forthright in saying, what are these people smoking? Because you know what? The March number has definitely diminished. There was like almost a 90% chance at one point that they're going to cut in March. Now, okay, it's still like a 66% chance of a cut in March. I got to tell you, I disagree. And I'm going to continue to disagree. In fact, last week's video, I was telling everybody, I'm like, I don't know what these people are smoking. I would get short bonds, which I showed you guys the trade that I did. When you go out to December, though, here's the kicker. When you go out to December, we're 525, 550. They're still showing like possibility of like 4%. You realize that's still like, the highest probability is like 5 or 6 cuts are still being priced in. I think it's crazy. And I'm going to tell you right now, that is the danger right now. So as the bonds fade, okay, the Fed was relatively quiet this week. They're not going to be as quiet next week. They're not going to be. We're at a holiday trade. It's on. Next week, Fed speak is going to get downright dangerous because the Fed comes out. You know what the Fed likes to do? They like to prognosticate. They like to use a little bit of rhetoric, if you will, before those FOMC meetings. And if they're actually going to get ahead of this and say, like, look, I don't know what you guys see, but I see strong economic data. If there's strong economic data, they are not going to cut rates. They're not necessarily going to raise rates, but they're not going to cut rates. And they may make statements to that effect. You make a statement like, hey, look, I don't know what you're thinking because we're not cutting rates. This marketplace is not going to like it. All right. It's problematic. I'm not telling you that, look, the Fed speak in general is just going to get dangerous. And the reason you got to be concerned about this is intraday volatility. Like, look at this. I mean, it doesn't look like much on the screen, but, one moment you're trading 47.20. The very next moment, 2 minutes later, you're trading, 4,700. You're like, whatever. What's 20 points amongst friends? But every data drop today was doing that. I mean, this is another 20 handle move in like 4 minutes. It's not good. And Fed speak, which we didn't hear much of this week, is actually going to really turn up that volume, meaning that intraday volatility, it can get hectic. Do not get caught in that crossfire. Again, that Fed speak is going to get downright dangerous in this next week of trade. Everything you do in this business, forward looking, okay? It's you don't want to be driving 110 miles an hour looking through the rear view mirror. You better look right ahead of you. And you got to know what's actually the danger is out there. The danger right now, economic data drops. So you know what? Go over to your calendar. Look at next week. You got to know the banks are actually going to be releasing, okay, late in the week. The banks, they don't even intimidate me. It doesn't matter to me like the banks, but some of the other data coming out, like even things like PPI and so forth, okay, just craziness inside of the marketplace with that. And again, we're starting to talk about there's a lot of different like CPI numbers coming out. By the way, it's not, okay, not critical amounts of data that really are going to influence me. And again, there's always data coming out, always data, wholesale inventories. Every one of these is this chocolate covered hand grenade being thrown to the marketplace, right? But it is the Fed speak that probably intimidates me the most in this next week. All right, let's look at some individual stocks because I often talk in general terms. Why? Because the marketplace, typically moves as a whole. And right now the marketplace is pretty much hell bent on whatever the bonds are doing. Okay, bonds, dollar's critical. I talked about the dollar extensively in last week's update. If the dollar, remains bid, meaning that if the dollar continues, all right, to the upside, that dollar continues to bid up, to me, that's incredibly bearish. But if the dollar bids up, I would assume that the bonds are going to continue to see some sell-side activity. Look, I'm not going to sit here and start to dispute we're overbought, we're oversold. Who cares? Maybe we are a little bit oversold. But the one thing, that people have to keep in their mind is markets, they don't tank from overbought conditions. Markets can really tank, though, from oversold conditions, which brings me, of course, to Apple, Apple, slippage in Apple. Bring up Apple and actually look at it in terms of auto expected moves. Now, Apple started the week, in and around just below that, in the neighborhood of about 193-ish, closing this week, tried for the corner and missed. It's ugly. bottom low end of like the 180s. It's a pretty significant move. Actually, here, let's put it on a year-to-date percentage. Apple's down about 2%. People, you just have to understand, okay? It's $3 trillion of market cap weighing on you. Now, that to me is one of the critical movers. Tesla also had a significant move, okay, early on in the week, kind of mellowed out a little bit after that. Overall, if you look at expected moves, though, Tesla caught the lower edge of the expected move. Apple, okay, I mean, again, Apple, it's a full-blown, like you're almost in 3 Sigma territory over here. Microsoft, okay, lower edge, caught the lower edge of the expected move. Meta, quite ironically, finished the week almost unchanged. The reason I'm actually bringing up different tech stocks is because I think there's going to be an opportunity in here. And the reason I think there's going to be an opportunity, there's a lack of correlation. It's disconcerting. What that basically means is, hey, look, we're still seeing these pockets of strength. And we're still seeing, okay, constant rotations. So the reason I brought up Apple is not to diminish Apple. Look, I just remind everybody that when there's sell side activity, that again, markets, they don't tank, okay, from absolute highs. Markets really start to get scary though when you see it, oh, it's straight down. And if you get a bid back under it, it can get even scarier because then there's something to sell into. So a lot of retail traders or investors, they're getting nervous inside of Apple. It's a big enough drop, okay, from the price point of almost 200, all of a sudden you fall right back on your face to like 180. You're almost in corrective territory. People really start to pay attention at that point. And that's exactly where we are. And it actually touched right into the 180, maybe bounced a little bit over here, but it's disconcerting, right? But here's the whole key to it, is that even though Apple's falling, okay, take a look around. All right, Amazon saw some sell side activity, as I said, okay, Google, but the sell side activity is mild. As I said, Meta, okay, Meta finished the week, as I said, almost unchanged. And we had Nvidia, okay, Nvidia, watch this one in terms of auto expected moves, looks a lot like what? Meta. And the reason I'm actually bringing those two up specifically, if there's going to be an opportunity and the markets are really going to start to see some sell side activity, unequivocally, you got to have Nvidia involved. You got to have Meta involved. And here's the good one. You got to have stuff like financials. Take a look at financials on the week. Realize that financials ended up, okay, let's just call it unchanged for the most part. I mean, they ended up, but it was a very, very mild move throughout the course of the week. But there's just, in a marketplace that's selling off over here, throughout the course of the week, you're like, there's no bright spots, but there are. And the point that I was making with this is go look at the advanced decline line throughout the course of this week. You realize, the market finished mildly higher today, but there were days this week where we saw some real sell side activity and the advanced decline line was positive in that. Now, you can look at the, glass half empty, half full kind of thing, but here's the bottom line when it comes to the marketplace. You can't make an argument or overbought or oversold when you're not seeing any degrees of correlation, especially oversold. If you want to start saying we're oversold, okay, let me ask you something. How is that oversold? You're like, well, no, tech is oversold, maybe. Okay, so what are we going to do? We're going to start buying tech and then sell some of the financials. That's why I'm pointing out the financials. Anyway, you want to shape this up, even if the marketplace rallies, okay? There's just not a lot of places to go to right now. In financials, do you want to start buying financials right before they have earnings? Do you want to start buying financials right before there's going to be Fed speak? Okay, I think that financials are actually a decent short at this point in time. The only one that I'm actually really not playing around with, not touching, is probably energy. There's too much geopolitical risk right now for me, so I'm done with that one for the short, in the short term over here. But I am definitely looking at the financials as a decent short, because if we're going to come off and we're going to start to see higher degrees of correlation, okay, this gets sold. I can even make an argument that if tech is being bought, they may turn around and actually sell financials, because again, we're actually trading in these pockets of strength and pockets of weakness. Keep that in mind this next week. All right, last but definitely not least, you got to look at the SPX. As I often term, it's the mother of all products. The SPX, again, we did definitively finish outside the expected move, which only implies one thing. Okay, look, it implies the market did something a little unruly. So let's call it what it is. So the expected move this week, it's plus or minus, it's right around $52. Okay, that was terrible. Plus or minus right around $52 is what we're looking for. Actual move, well, here that was about that 47.18, and we're closing here just about 4,700. So what did we do? A shy pass, just shy past this. We moved close to $70. Okay, the actual move was closer to $70. So tried for the corner and missed. Where do we go next week? So you see some volatility starting to emerge, but what's on the docket for next week? Now, this is interesting because here we are, we're 15 minutes after the close. This is the official expected move. It's about $60.78. $60.78. And I'll actually draw and I'll hand draw the expected move. But to me, that leaves something to be desired. And I'm going to tell you why. We just came out of holiday trade. It was January 1st. There was footballs. There was hangovers still on the 2nd. They're traders, people. You got to understand that. We only had like a $52 move. Now we have an extra trading day, and we're only up to what? Not even $61? Doesn't seem right. Volatility still seems inherently low. Okay. That's one of the areas I keep saying. That's why it's so disconcerting. Okay. Again, we have this marketplace where all of a sudden good market news is not so good for the marketplace. Let's hear what the Fed has to say this next week. And I got to tell you, okay, you need to see real volatility. There's got to be a little bit of fear, again, loathing in the marketplace before I step out and really want to start to sell some premium in here. I've been patient. I've been incredibly patient. Don't be a volatility starved animal. Wait for your entries. Thanks everybody for joining us here at TheoTRADE. Have a wonderful weekend. Bye-bye.